Let's look at 9 financial strategies to maximize the valuation of your business. If you're ready to optimize your business's financial valuation and performance, you can maximize its valuation. I'm John Colley, and I've got over 30 years of experience as a senior investment banker. I've seen firsthand how crucial it is to master financial strategies in order to maximize business valuation, particularly in M&A situations. In this video, I'm going to break down 12 key financial strategies that will not only boost your company's value, but will also set you up for a successful sale. And make sure you stick around to the end, because I've got a bonus strategy that could significantly enhance your business's appeal to buyers and its valuation. Let's start with the first strategy, gross margin analysis. Gross margin analysis is a fundamental metric that speaks volumes about your business's profitability. Simply put, gross margin is the difference between your revenue and the cost of goods sold, expressed as a percentage of revenue. Why does this matter? Well, a higher gross margin indicates that your business is retaining more money from each sale, which can be reinvested into the business or directly contribute to profitability. Just take a look at Nvidia and its 75% gross margin. To improve your gross margin, consider reducing COGS, cost of goods sold, by negotiating better terms with suppliers, finding cost-efficient materials, or streamlining production processes. Another approach is to increase pricing if the market allows, without significantly impacting your sales volume. Lastly, optimize your product mix by focusing on higher margin products or services, and that can make a substantial difference as well. Next, we turn our attention to cash flow management, often described as the lifeblood of your business. It's not just about profitability, it's about having enough liquid assets to cover your operating expenses, invest in growth, and weather financial downturns. There are 3 types of cash flow you need to be familiar with. Firstly, operating cash flow. This is cash generated from your core business activities, and it's the most crucial type as it indicates whether the business can sustain itself. Your investing cash flow involves cash used for investments in assets or received from the sale of assets, which indicates either growth or shrinkage. And then finally, financing cash flow are cash transactions related to financing, like loans or dividends, showing how a company funds its operations. To improve cash flow, you can speed up receivables by implementing stricter payment terms or offering discounts for earlier payments. Extending payables, negotiating longer payment terms with suppliers, keeps cash in the business longer. Finally, optimizing inventory by reducing excess stock can free up cash tied up in the supply chain. Expense management is another critical area to focus on. It's important to understand the difference between fixed and variable costs. Fixed costs such as rent or salaries don't change with production levels and need careful control as they impact your break-even point. Variable costs like materials and labour vary with production, and managing them effectively can directly impact your gross margin. To control costs, consider benchmarking your expenses against industry standards to identify areas where you might be overspending. Implementing automation and efficiency improvements can reduce labour and operational costs. Regular financial reviews are also essential for finding and eliminating unnecessary expenditures. Now let's talk about optimizing your revenue. Focus on promoting high margin products or services, as these contribute most to profitability. Customer segmentation can help tailor your marketing and sales efforts to the most profitable segments, increasing overall revenue. Cross-selling and upselling are powerful strategies to increase the average transaction value by offering complementary products or premium versions of your existing offerings. Additionally, consider introducing subscription-based services for consistent and predictable revenue streams, which are highly attractive to potential buyers and highly valued in the M&A process. Accurate and regular financial reporting is the backbone of good business management. You need to regularly produce financial statements, including the income statement, the balance sheet and cash flow statement to keep track of your business's financial health. Key financial ratios such as the current ratio, quick ratio, debt to equity ratio, and return on equity are also critical for assessing liquidity, financial leverage, and profitability. These ratios help you to understand how well your business is performing and where there might be room for improvement. Financial forecasting and budgeting are essential for planning and making informed decisions. Forecasting involves predicting future revenues, expenses, and cash flows based on historical data and market trends. This helps you plan for growth and allocate resources effectively. Budgeting, on the other hand, creates a detailed financial plan that aligns with your strategic priorities, ensuring that funds are used wisely and efficiently. Together, these tools allow you to control spending and ensure that your business is on the right track. Investing in growth is crucial for increasing your company's value. Reinvest a portion of your profits into areas that will drive future growth, such as research and development, marketing, or expansion into new markets. Capital expenditures, CapEx, which involves investing in long-term assets like machinery or property, can enhance operational capacity and efficiency, contributing to long-term profitability and making your business more attractive to potential buyers. Scenario planning is all about being prepared for the unexpected. Stress testing your business under various adverse conditions, such as economic downturns or the loss of a major client, can help you build resilience and ensure financial stability. Developing best and worst case scenarios allows you to predict different outcomes and plan accordingly. This preparation ensures that your business remains strong no matter what challenges come your way. Finally, benchmarking and competitive analysis are essential for understanding your position in the market. Regularly compare your financial performance against industry averages to gauge how well you're doing. Understanding the financial performance of your competitors can also help you identify areas where you can improve or innovate, keeping you ahead in the market. By the way, if you're serious about mastering financial metrics and maximizing your business's valuation, be sure to check out my UDEMY course on mergers and acquisitions. It's packed with in-depth insights that can help take your business to the next level. I'll put a link below in the description. Here's the bonus tip that I promised you. Set key performance indicators. Identify at least 6 critical financial metrics to be your business key performance indicators. Remember, what you measure moves. Here are 6 key performance indicators, KPIs, that are essential for measuring and managing the growth of a business, but don't be afraid to choose KPIs which best suit your business. The first is revenue growth rate. This measures the increase in a company's sales or revenue over a specific period, usually compared to the previous period. This can be a month, a quarter, or a year. It indicates the effectiveness of sales and marketing strategies and the overall market demand for your product or service. Number 2 is customer acquisition cost, the total cost of acquiring a new customer, including marketing, sales, and other related expenses. You really need to know this. It helps to assess the efficiency of your customer acquisition efforts and informs decisions on budgeting and scaling marketing campaigns. Number 3 is the customer lifetime value, or the CLTV or LTV. The total revenue expected from a single customer over the duration of their relationship with your business. This provides insight into the long-term profitability of customer relationships and guides customer retention strategies. Number 4 is gross profit margin, the percentage of revenue remaining after subtracting the cost of goods sold. This indicates how efficiently a company is producing goods and services and its ability to generate profit. Number 5 is Net Promoter Score, a metric that gauges customer satisfaction and loyalty by asking customers how likely they are to recommend your business to others. This provides valuable feedback on customer experience and helps identify areas for improvement to boost customer retention. Finally, number 6, operating cash flow. the cash generated by a company's regular operating activities excluding capital expenditures. This reflects the company's ability to generate sufficient cash to maintain and grow its operations, indicating financial health and stability. These KPIs provide a comprehensive view of a growing business's health, helping to guide strategic decisions and ensure sustainable growth. If you found these strategies helpful, great! Don't forget to subscribe and hit the like button. Your support always helps me to bring more valuable content to this channel, and I love creating it for you. Now, if you found all this helpful, then the next thing you need to do is to learn more about the M&A process itself. And I'll provide a link to my video which explains this in detail and guides you through the M&A process step by step. You really won't want to miss it. So thank you for watching this video, and I'll see you very soon in the next one.